Okay, good morning everybody. I think we're online and ready to go. So, good morning all. I'm Councillor Eric Kerry and I'd like to welcome you to the annual general meeting of the Nottinghamshire Pension Fund Committee. This meeting is now being broadcast live on YouTube so that viewers can hear presentations and questions in today's meeting. So to enable them to do that, can you make sure you turn on your microphone when you wish to speak and off when you finish, please. Before we begin the meeting, there is nobody in the public gallery, so I don't think I'll go through the comments about the public gallery unless somebody arrives. You remember in our last meeting we heard that our pensions administration team had successfully managed to recruit 4 apprentices, and I'm really pleased this morning to have met and welcome those apprentices, which Billy Cowling, second from the left, Louisa Marshall, second from the right, Sophia Butt, who's on the right hand side, and Zach's on the left hand side on the back there. So I welcome you all. I'm sure the members will look forward to working with you as you develop your career at Nottinghamshire Pension Fund Committee. Thank you. Item number 2 on the agenda is apologies for absence. So may I ask Joe to confirm any apologies and substitutions? Oh, minutes. Yes, it's not on here. So okay. Yes. So item number 1 on the agenda, which is not on my briefing note. Can we ask for the minutes of the meeting to be approved from last year? You were right. Okay. Okay. I am right. It's not always like this. I can assure you. We're much more proficient. Okay. So moving on to item number 2, apologies for absence. So may I ask Joe to confirm apologies and substitutions, please, Joe?
Thank you, Chairman. Apologies for that. Force of habit. We normally start with minutes. Now, I was obviously in the zone. Today we've got apologies from Councillor Eddy, who's being substituted by Councillor Butler, from Councillor Place, who's being substituted by Councillor Allen. We've also got an apology from Sue Reader, who's the scheduled bodies representative.
And may I also add apologies from Councillor Jackson, who's unable to get in this morning for the obvious reasons around the area at the moment. Thank you. Okay, item number 3. Oh, sorry. Are there any other apologies for absence, please, from anybody else aware? Okay, that's a no. So let's move on to item number 3 then, which is declarations of interest by members and officers. 3A is, do any members or officers present have any disclosable pecuniary interests to declare? I see no hands raised. B, do any members or officers present have any private interests, either pecuniary or non-pecuniary, to declare, please? Again, that's a no. Moving on to item number 4, which is the notes of the last year's meeting, which was held on the 12th of January 2023, and they're from page 3 to page 8 of the agenda pack. So, do any kind of members please confirm the notes of that meeting? We okay with that? Okay. Thank you very much. So we move on to our first substantive item today, a very important item, number 5, which is actuarial issues, and we've got Barry McKay from Barnett, Waddingham here with us today, who will make his presentation. So, thank you, Barry.
Thank you, Chair. Good morning, everyone. I think I was here this time last year, roughly, and gave a presentation on the results of the valuation, which the last formal valuation was carried out at 31st March 2022, unbelievably, 2 years on already. Today I'm going to talk about what's happened since that valuation, where the fund is now, and why the funding position has moved. You may have read or heard there's lots of discussion and commentary around funding levels, both of private sector schemes and the LGPS at the moment, because of all the volatility in markets and high inflation and movements in gilt yields and so on. For what I'm going to say over the next half hour, probably keep these things in mind. The funding level is what we describe as the ratio of the assets to the liabilities. So how much the fund is holding relative to how much we think they need, how much the value of the benefits are that need to be paid out to the members that have accrued those benefits. The point about that is that the value that the actuary places on the liabilities is just an estimate at a point in time, and that moves continuously. So by the time we carried out the valuation back at 31st March 2022, by the time I presented those results, things were already moved on quite significantly. So that's a key point. This is just a snapshot in time, and the results are shown today again at 31st December. It's just a snapshot in time, and it's always moving, and that's because we're trying to budget for 10, 20, 30 years or more to make sure we have enough money in the fund to pay all those benefits, and that's why we carry out a valuation every 3 years to refresh those figures and to monitor the funding level and so on. The second thing is, we don't want to give away the story, but the funding level has come down, and I'll explain why that is. One of the two main reasons are high inflation, which everyone has suffered from across the LGPS and other pension schemes, but particularly LGPS, because pension increases are not capped. And secondly, fairly flat, benign markets. So again, markets have been pretty flat in the last 21 months, and I'll explain why that impacts the funding level. Again, all LGPS funds will have seen that. You're no different. So that's kind of context for today's talk. If we could just go into the next. Just a quick agenda. So that's thanks. What we'll do, quick recap of where we were at 2022, 31st March 2022. What's happened since then, and then what has gone on to drive the change in the funding level, and then we'll have a quick look at where we think we might be at 2025 and what position we're in for 2025. Happy to take questions whenever, Chair. Quick recap of where we were at 2022. Just by coincidence, the funding level was almost bang on 100%. So our estimate at that point was you had around £6.5 billion of assets, and the value we placed on all the benefits that have accrued to members at that point in time was also about £6.5 billion. So the funding level was 100%. You had a very small surplus of £9 million, but in the scheme of £6.5 billion, it's not much. The funding level had increased, as you can see, from 93% of the previous valuation, so up from 93 to 100%. And the split of the liabilities across the active, deferred and pension status is shown on that chart. So a good position in 2002, but again, that's just one point in time. If we'd gone to the next slide, please, Tamsin. This shows, so that's all to do with the past. That's where that looks at what's accrued, all the benefits accrued in the past and the assets you've saved up to meet those benefits. Looking forward is what employers need to pay to meet the cost of benefits accruing in the future following valuation date. And this slide just recaps that. So what we call the primary rate was 19% of payroll for employers. Now, every employer will have their own primary rate specific to their membership profile. So this is just at whole fund level we're talking. It was 19%, and that was up slightly by about 1% from 2019, mainly because inflation had increased over that period of time. So that pushed the cost of the future benefits up slightly. So that's where we are 2019.
Can I come in and ask a question, or make a question about what you just talked about, the primary rate, etc.
Sure.
At the end of the day, the employers are paying for pension contributions that they have to make as employers for the members, but ultimately it's the taxpayer that has to pay. In the LGPS system, all the stuff that we're doing is for work done by the civil service or whatever exactly how you describe the employees of the local authorities. They're in our fund. So very important to realise, in my view, that when we see the impact on the primary rates and the employers' contributions, it's taxpayers that are paying that. So what we're trying to do here is to minimise the cost to employers by having good investment returns that will match our future liabilities. So I just think it's important to stress that at this time. I don't know if you're going to talk about that later, but
yeah, no, that's good. That's a good point. So not all the employers will be in local authorities,
yeah.
but yes, the majority, a large portion of liabilities are, and future cost will be related to local authorities. Ultimately, can fall back on the taxpayer, I suppose. And one of our jobs is actually to try and keep contributions and the funding level as stable as possible, because you're an open, long-term scheme, and that's why you invest the way you do in growth assets and so on, because you're trying to get as good returns as possible. Because the way we fund the pension scheme is through investments and returns and contributions. So investment in cash, that's the only way we can fund it. So the more we achieve in investments, the less cash needs to go in. But our objective at the valuation is always to keep things as stable as possible.
Thank you.
Okay, so what's happened since March 2022? In short, a lot. Even before we had ran the numbers, or were running the numbers for the 2022 valuation, we had the mini budget, which caused markets to go into chaos, and gilt yields, which were already increasing, leapt up quite significantly in the short term. We've had various geopolitical issues around the Russian-Ukraine war, which had impact on markets and supply demand. That chart there, I don't know if you can read it at the bottom left-hand corner, but I thought it was quite interesting. Before the war, Ukraine produced or sowed some 17 million hectares of wheat, which is equivalent to the size of Austria and Czechoslovakia. Post war, it's only it's about 70%, so now the size of Belgium. So the point in that is that there's a massive impact on supply, demand, and the cost of various items across the world, and that had a bit of an impact on markets. The top right here is inflation. We all know what's happened with inflation, and I'll talk more about that when we come on to the results and what's happened to the fund level since March 2022. But inflation obviously reached a high, and that has impacted the liabilities, as we call them. So all the members' benefits will have increased in line with CPI inflation, which was 10% back in April 23, and therefore that pushes up the liabilities. That chart just shows how it's hopefully going to track back down to something a bit more. I don't know what normal is anymore, but something around closer to the Bank of England target. I don't think it will get there, and I'll explain what we did on the valuation later. And then the war in Gaza, of course, has also had impacts on markets. Even McDonald's get dragged into this, where they had got bad PR and had their profits.
Could I ask you a question? Yeah, I understand that, but why need to put the inside story of the mini budget? I mean, what's all that about?
So,
can you explain to me how that a few days or has impacted so much, and why would that need to be put on there?
Yeah, so when the mini budget took place, the markets got a bit spooked, and gilt yields went up dramatically, which means that the value of any bonds you were holding fell significantly. I guess the key point for me is that actually the bonds are meant to be kind of risk-free. They're meant to be a sort of risk-free asset, but in fact that showed that's not the case, because bond values have halved almost within a space of a few weeks. As I say, I think gilt yields were trending up anyway, but that just accelerated dramatically the whole impact on funds. Not your fund because you don't hold a lot in bonds, but a lot some other pension schemes saw a significant hit on their assets in that way.
Yeah, I understand what you're saying, but yeah, these things, the effects on the stock market last year, there were loads of different things that affected the stock market. For you just to put that, because that's a political statement, really, on a pension, I'm not really happy about that. I'm going to state that now. But hey, you know what you're doing.
I'm not making a political statement. It's just I'm all interested in what the economic.
But I don't think that is actually what's affected that. Those few days, I think there's a lot of rubbish spoken about that. That's only my opinion. I think there's a lot of rubbish about that. A few days Liz Truss was in charge, didn't have the effect that it's a political. Yeah, well, you can think what you like, but that's true. You know, when you do think what you like, yeah, but that's true. Thank you. Thank you.
Okay, I'll move on. So, what's from that? What's the impact? And this is actually coming on to this kind of point. Higher interest rates, which the government had to use to try and curb inflation, should, in theory, I'm talking about theories that I came up with a long time ago, lead to higher returns, and I'll come back to that point if you want me to. But briefly, if interest rates are higher and you expect the government to return a risk-free rate, then if you're going to invest in other assets like and so on, you expect to be rewarded for taking that risk. So if gilt yields have gone up, if you believe they're a risk-free asset, then you expect other asset classes to return more. I'll come back to that if you want me to, and take questions. I'm not necessarily a believer in that anymore, which is part of the reason I'll talk about your funding level later. So that's that part. That's in theory. What's actually happened was assets were pretty flat. In fact, I think the return over the first 12 months was negative. I think I've got about minus 1.75%. Returns have been more positive over the last 9 months, so we're now into positive territory for the 21-month period. As I said at the start, that is not because of the way your fund is invested or your asset allocation. That is because of markets in general, and you are just in the mix. If you looked at the returns across all 86 English and Welsh LGPS funds, you would see that the returns have been broadly around nothing over the last 21 months. Some have done slightly better, some have done slightly worse, but funds are not keeping pace with the discount rate that we set, which we'll again talk about shortly. I mentioned at the start we are keen on stability, both at the funding level and contribution rate, and our model is not correlated to gilt yields, for example, and therefore it is more stable. So the fact that gilt yields did go up, our discount rate has not moved in that way, and we've kept things as stable as possible. But as we'll see, the funding level has come down, as you probably know, and we're hopeful that assets can deliver more positive returns over the next 15 months before the 2025 valuation. So, an impact on liabilities, already mentioned inflation being particularly high. The pension increase award is set at prior September. So, depending on the increase from 1 September to the next, that is the increase that members will receive the following April. And that was 10.1% in April 2023. So, good news for members because everyone's pension increased by 10%. Not so good for the fund because that's pushed liabilities up, all else being equal, by about 10%. The pension increase order at the end of September 23, which will apply in April 24, was struck at 6.7%. So again, we're going to see a pretty material increase come next April, this April now as is, on the liabilities. And again, you'll see that increase the past service liabilities. But what that might do, it depends on your beliefs, is that we might see higher returns in the future. And when we're under a higher interest rate and inflation environment, we tend to have higher returns, and therefore that will bring the value of the liabilities back down a little bit. Again, I'll come on to that when we see the results, which is what we're going on to now. So, The assets, we've estimated the assets at 31st December 2023 to be just over £6.5 billion. So a small increase in where we were at March 2022. So returns have been slightly positive now. And this chart just tracks the funding level from 31st March 2022 on the left, where you can see we're 100% to the current 31st December 23, where the funding level is now down to 91, just over 91%. So assets have remained pretty flat. Liabilities, on the other hand, have increased from £6.5 billion to 7.15, and that's mainly because of inflation, as I mentioned earlier, plus members accruing more benefit and so on. If we track the line, the green line, which is the one we're focused on, that's what we call the smoothed funding level. You can see there's a bit of a sharp increase in the funding level at September 23, and that's just because we remodelled. Tamsin provided an updated asset value at 30th of September, and so we remodelled the liabilities, and by that we just looked at what's happened in the markets and did some work behind the scenes on the assumptions to try and make sure that the assets which are now at market value are consistent with the liabilities. So the what we call the discount rate, the expected return on investments, or the prudent estimate of that has gone up slightly. So we've seen a bit of an uptick in the funding level up to, as I say, to 91% at 3rd September, and it's remained pretty flat for the 3-month period. So that's where we are. The next slide gives a bit more detail about why that's happened. And I'll pick out the main points here. What we're showing is a reconciliation from the 100% to the 91%. The purple bars are good. They've improved the funding level, and the yellow bars are bad. They've reduced the funding level. So you can see all employers have been paying contributions, which is more than met accrual. So that's the first two bars. So more or less matched off, but all those benefits accruing have been matched with contributions. The next bar is that investment loss. So even though assets haven't lost money, they are lower than the assumed return. So your assumed return was 4.7% at the valuation. So over 21 months, that's about 8.5. And the fact the assets have gone up by about 1. So there's this gap that's hit the funding level. And as I say, that's not just your fund, that's across the LGPS and wider, because markets have been benign. So that has impacted the funding level and brought the assets down from where we expected them to be, even though they've stayed the same in a monetary amount. If we skip over the change in discount, I'll come back to that. The change in inflation is important. So there's two bars here that are involved. We can see the furthest one to the right, which is minus 8.7. That's allowing for what's actually happened. So that's the actual inflation that's been now baked into the liabilities. What's offset that, fortunately, is the change in inflation, which is positive at 6.5. Now that's not a surprise. We allowed for that at the 2022 valuation. What we did was we knew that actual inflation was going to be really high, so we made a higher, when we looked at the long-term average inflation, we made that higher than we otherwise thought it would be to allow for that short-term spike in inflation. So we've effectively accounted for quite a bit of that high inflation. It has gone on a bit longer and higher for longer, so that's why there's a bit of a gap. Our guess was that it would be 10%, then come down to about 5%, then come down to something like 2.5% for the long term. The first part and the third part's right, so we knew it was 10, it's now down to about 2.5 at our estimate, but the middle bit was a bit higher than we allowed for, so that's why we've still got a bit of a hit on the funding level. And the only other two bars is this change in discount rate and valuation basis update, and that's that remodelling part I just talked about. So we've looked at your asset allocation, we've ran our model, and we've increased the discount rate slightly, which had fallen down because of expected returns, but we think it should be a bit higher, so they effectively net off, and that's that spike we saw at 30th September. So bringing all that together, the main two elements are the investments not keeping pace with the discount rate and inflation being slightly higher than we have anticipated over the long term.
May I come in on the question on that? So I think you've just explained why that your assumptions for the 2022 valuation on inflation were lower than actually happened in the short term. Obviously, long term is a different thing. So do you have any idea what that difference in assumption would have made to our valuation as at 2022? Should you have put a higher assumption into your model?
Yeah, so because we run things out for about 20 years, we'd assumed in year one it was 10%, year two it was 5%, year three onwards it was 2.5%. To match off, we'd have had to, as I say, it was 10% and now it's 2.5%. Either we'd have had to, the middle year, a bit higher, and therefore instead of using, the valuation we used 2.9, we'd have probably had to use something like 3%. So we're only at 0.1 out, which, we're not going to get it bang on. But if we use 3%, then that's equivalent to that 2% over 20 years. So it's not far away.
Thank you. William?
Yeah, can I just make sure I got this right about the discount rate? On this slide, you're showing the change in the discount rate is showing an increase in the deficit. The previous slide, you were showing it as actually the opposite, an increase in the funding ratio, therefore a decrease in liabilities. Or have I missed something there?
No, we're showing as a slight increase in the funding level because it's the 4.2 and the 4.6. So the 4.6 is good and the 4.2 is negative, so it's a slight improvement. But what's happened, if we jump back to the last slide, is we've tracked that you can see the funding level coming down, and that's because the discount rate has been coming down, pushing the liabilities up. So from March 22 to September 23, the discount has had a negative impact on the funding level, and then come September we've made a step change and pulled it back up a little bit.
Okay. So your point is that the discount rate had a negative impact over the whole 21-month period, even though that sharp rise will have reduced the negative impact.
It's broad. Well, the 4.2 and 4.6 broadly cancel out, so it's almost neutral. The discount rate is pretty much neutral. The discount rate we used at 2022 is 4.7. It's now 4.74, something like that. So it's pretty much the same.
Thank you.
Anything else before I move on? Okay. No actual presentations complete without a slide on life expectancy. We continue to see, unfortunately, some impacts on life expectancy not just because of the pandemic, other factors. This chart shows, if you can see it, is the excess deaths because of both because of COVID, and not. So that it tracks. Believe it or not, the CMI have got expected deaths on a weekly basis. And that varies according to the time of year, and they track what actually happens against what's expected. Obviously, at peaks in the pandemic, we saw significant numbers of excess deaths, and we did some work for your fund to analyse what impact that had, which was, in terms of pension liabilities, very little, because it's those older members, unfortunately, that tended to be dying from COVID, and therefore they didn't have such an impact on the fund. But the point on this slide is that the continuous mortality investment CMI have carried out more modelling, and they see that they think life expectancy is continuing to slow down. Improvements in life expectancy continue to slow down, that is. So where we used to see improvements of about 2 years per decade, from 2011 that started to slow down. A number of reasons for that, and that slowing has continued. And then, of course, with the pandemic, which made it, which could have been a bit of a blip. But even ignoring the pandemic, they think that the life life expectancy increases are beginning to plateau, so increasing much more slowly than they have done in the past, and by the past I mean the last 100 years. So this is a kind of new, relatively new effect, even though it's now been happening for about 10 years. The impact on the fund of that is, at 2022 we'd allowed for that slowing down, but by 2025 it looks like we'll be allowing for it even more, so that will dampen down the increase on the liabilities, if any. So in fact that probably would improve the funding level by 2 to 3% if we adopted those assumptions.
Microphone, please.
Have you adopted those assumptions, or are these assumptions you're going to adopt?
We will review those assumptions at the 2025 valuation.
So you haven't factored them in yet?
Not yet, no. We tend not to do that into the valuation because it's quite slow moving. The data takes time to come through and so on for various reasons. So we need to get the fund membership experience, analyse it, make assumptions.
But yeah, I've got some questions later. I'll just save to the end. Okay, just let you know.
Yeah, sure.
Okay, we're almost there. So, and so bringing all that together for 2025, there's still lots of uncertainty out there, and that's what we deal in. There's a very key difference between risk, which we can measure and at least give you some idea, to uncertainty, which is by nature very difficult to predict. And there's lots of factors around that which are both positive and negative for the valuation. We'll need to consider all that ahead of setting the 2025 assumptions. The more uncertain there is, the more we have to put that prudence in there, but we had a decent amount of prudence margin at the last valuation. We'll aim to do something similar again this time, so we keep, as I keep saying, results as stable as possible. But we were in a decent place at 2022. We're 100% funded, albeit that is just at one point in time. Again, one of the key objectives will to keep employer contributions stable and affordable, which under our approach, which is generally very stable, we think we will manage to do. Back to your point about protecting taxpayers and protecting employers from any unaffordable sudden increases.
Okay. Oh, is that the end of the?
Sorry.
That's just
That's the end.
That's the end. Yes. Okay. Councillor Chapman, Graham, you want to ask some more questions?
Fine. I need a bit of indulgence on it. I'm coming at it from the point of view.
Barry, would you turn your microphone off until?
I'm coming at it from the point of view of councils that are making contributions. And I'm coming at it from the point of view that councils who are struggling massively to balance their budgets. And I'm coming at it from the point of view of people whose jobs are in the line at the moment. Right now, a big factor in any council's budget is a pension contribution. And bits of variation in your assumptions probably means somebody's going to lose their job, right? Or somebody's going to maintain their job. So it's absolutely critical. I know making assumptions is very, very, it is an art and it's a science, and I wouldn't like to have to do it. But I'm still struggling to understand what the implications are for councils who are contributing, and what the implications are for frontline services that may or may not survive as a consequence. For example, I have got here a letter which has been sent to our Chief Executive and to the Chair of Finance, or the responsible for finance, and it's saying, I'm connecting this with significant funding improvements in the Nottinghamshire Pension Fund. In short, there's an excellent case for an immediate freeze on Nottingham City Council's secondary rate contributions, which could save, I won't give the amount because X amount, but it's substantial over the next few years. So, in theory, that gives you a bit of hope. Now, what you've done is just poured a bucket of cold water on that. But I would also go back. I spent a lot of time last year supporting Liverpool City Council with their problems. And one of the things I pointed them to was their pension fund. And they managed to renegotiate a £10 million reduction in their contributions. Right, now that may well be the case in 22-3, right, and you're telling me it's now changed. So basically, my question is, what scope is there, if any, and it sounds as though there isn't, right, for any reduction of contributions from the councils to the pension fund, right? And that's my first question. And the second question is, to what degree are you being pessimistic or optimistic compared with some of your peers?
Okay. Yeah, I'm well aware of the issues around councils and budgets and so on. And I'm sorry for pouring cold water over the. I guess in the first line in the letter about the funding position, whatever, significantly improved. I don't know where that came from, because that might be from the 2022 outcome, I guess. Yeah, so I probably wouldn't agree with that first statement, but obviously one of my jobs is to protect the fund and make sure there's enough money in there to pay the pensioners and future pensioners. The outlook at the moment is that, as I've just explained, the funding level has gone down. So in fact, the council should be paying in some contributions to meet that shortfall. We don't change contributions from one valuation to the next. We certify contribution for 3 years, and then generally there is now something in regulation allowed to review contributions for an employer, but that's generally if the liability profile has changed or the covenant has changed, not because markets have done what they've done. But on the one hand, there's a deficit, and therefore you'd be paying deficit contributions in. On the other hand, I think the primary rate, so the future cost, has come down slightly because our long-term expectation of inflation at the moment has come down slightly, although William may disagree with that. We were chatting about that earlier. So all being equal, they're probably in a similar place. I don't think, pouring more cold water on the letter, that there's a reason why you reduce contributions at the moment. I can't see why you could do that, I'm afraid. And I take your point about services and jobs and everything else, and that's not. And I can talk to the fund, but there's no rationale as to why we would do a contribution review and reduce contributions at this point in time.
I'm sure this has been seriously thought about. This is somebody's view. This is a professional's view on the market, future funding liability, all those kind of things. And actually, it's not just Barry that does this. Barry does it in conjunction with the fund and our investment advisors too. So it's not just a single view. It's a view after discussion and everything else. So, but on your point, that I think we made it earlier, that we are trying to make the cost to employers a minimum by that mix of managing our liabilities and our investment performance. And we'll look at investment performance at a later date in the meeting. So totally understand your concerns. I don't think we're going to resolve that in this meeting, and I'm sure those discussions can continue elsewhere. Thank you. Councillor Waters, Lee.
Thank you, Chairman. Just slightly carrying on that theme, particularly in Nottingham City, I think that council are going bankrupt because of dodgy investments, and that's potentially why, sadly, some people may be losing their jobs, and it's very unfortunate due to the running of that particular council. But on this pension fund, Department of Levelling Up, potentially we're going to be pushing more money into private equity, potentially more higher risk investments, a bit like what that council did, but now we're going to do that over this pension fund. Have you factored in the returns, the future potential returns on that, and what do you think the impacts will be?
So, yes, as part of the calculation of the discount rate at the 2022 valuation, we look at what the fund's holding in each asset class, private equity being one of those, although I don't think I think that it's quite a small element of private equity that time.
Yeah.
And we look at what we think. We determine what the best estimate return is for global equities, UK equities, private equities, so on, property bonds, and then we take a weighted, calculate the weighted best estimate return. So that is factored into that calculation of the discount rate. And of course, we also run a financial model to look at the risk associated with that asset allocation. So it's all within the model.
Just to add to that, Councillor Waters, you have been involved before in the working groups that look at our strategic asset allocation, and we've had presentations also in private from Barry and his team. So I think we are aware of the implications for the work we're going to be doing after this meeting for the next asset allocation. William.
Yeah, if I can just add that, I mean, a lot of sympathy for where you're coming from on that. The government's response to the consultation made it very clear that although they had an ambition to put more money into private equity, that fiduciary duty came first. It really was up to us.
Absolutely.
And this afternoon, I'm actually going to propose a reduction to private equity. I'll give my reasons why. Second point is that actually the return expectations for private equity and listed equity are very, very similar. They're not hugely different. You can argue they should be different, but they're actually not that different. So it won't have a big impact in terms of the actual kind of funding level. And then finally, as the chair has just said, we will be discussing this afternoon and open conversation in the working group, and we can talk about it further then.
Yeah, and I guess the private equity thing is that it's a more risky asset class to invest in. So if the returns are similar, then it makes sense to go for the less risky option.
Yeah, I mean, the projected returns used both mine and Barnett Waddingham's are fairly similar. Now, they may or may not be right. That's a very different issue.
Thank you. Are there any more questions or comments from members, please? Oh, Councillor Butler.
Yeah, thank you, Mr. Chairman. Obviously, I'm not normally on this committee, and so I wouldn't pretend to be any sort of expert on the history and all the rest of it. But putting a very simplistic question, and I hope it's not a silly question, but our big concern here is the overall pension fund, the Nottinghamshire Pension Fund. Would it be fair to ask just how we're doing in general compared to comparable schemes, council schemes? I don't know if that's a difficult question or a particularly easy question, but obviously our big interest is the Nottinghamshire scheme. So thank you.
Yeah, so I think it's mentioned in terms of the asset side, how the assets have performed. You are, and just in the mix with all the other LGPS funds because and you've all got slightly different asset allocations. Some have done slightly better, some have done slightly worse, but overall the asset returns have been relatively flat, and that's you're the same. We've seen a bit of an uptick recently, so we've got some slight positive returns, but you're no different from the rest of the LGPS funds. On the liability side, that we do see differences across different funds because of the way they model the liabilities and estimate liabilities. From our point of view at Barnett Waddingham, all our funds will have seen similar changes in the funding level because we follow a similar model. Yeah.
Are there any more questions or comments? Sorry, Graham.
Guys, I just want to respond to the councillor over there. I've forgotten his name. Sorry? Right, yeah. I do think it's important not to be using the word bankruptcy. It's a press shorthand. Section 114. I mean, you're a man that prides yourself in detail and accuracy. Section 114 is not bankruptcy. Councils can't go bankrupt. You go bankrupt when you don't have cash flow. Nottingham City Council has cash flow, and it is not bankrupt. Okay, so I think it's important. I understand why the press use it. I don't think we should be using it. The second point is about dodgy investment. You're probably referring to Robin Hood Energy. Now, I was one of the greatest critics of what happened to Robin Hood Energy, but the issues in the council are not to do with Robin Hood Energy. That was perfectly absorbable within the reserves we had. It is to do with service pressures. Thanks.
Thank you, Graham. Look, can we just try and keep this politics out of this? We are talking about a very important issue here, and we've worked together for a long time now in getting fund performance and management up to bring it back to 100%. And I know we've got this disruption now going on. Our job is to look after the people out there, not to do this political stuff in this environment, please. Any more questions, comments, please? Councillor Camilleri.
Yeah, just an observation. You didn't really answer his question. In fact, you didn't give us any comparison. You just said some statement. Would you think it's quite possible that the fact that the poor investment decisions by investment companies can be easily hidden for the fact that the country's in a bit of a mess? They're not doing very well. I mean, we've got some, I won't mention the names, some investment that aren't doing very well, and no doubt they'll come with the same argument: inflation, this, that, and the other. Yeah, some investment companies are doing really well, and would that be possible? Would people be blaming things where they put on poor investment? Yeah, it's not that really. It's just that they're not very good.
Let me come in this before we go back over, please. So, look, this is about the actuarial evaluation in the future and whatever. The decisions about investments and whether we're doing well, bad, whatever is part of a different discussion that we're having another presentation about. So, can we try and keep the questions? Yes, you have to make assumptions, Andre. I totally understand that, but that's a separate element of the work we do. He has to understand what our investment returns are and expect returns to be able to model it and look at how we're going to pay our liabilities. That's a different question, in my opinion.
Not that I'm thinking, but obviously it's a brilliant. There are some problems in the economy. We know that, and some people will blame that on why they're not having very good investments. Some investments are doing really well. Some LGPS schemes are doing really well, not really well, but better than ours. And I think that we should know how we could do in comparison with everybody else, so we can make decisions on that. We can't just have a bland statement where, well, everybody's not doing. Sorry, with respect to you, everybody's not doing very well, and we're not doing very well, and that's no excuse. Because, like you said before, Eric, all we're bothered about is the people out there and their pensions, and we want the best for them. And I just don't want them making excuses for poor investment decisions and blaming it on everybody else. That's all.
Okay, well, I'll just finish this one. Okay, Barry. But Barry is not our investment manager. Barry is an actuary. Barry, would you like to say
I'll just reply. First part of the answer is what Chair has just said. I look after liabilities, not assets. So I'm not going to comment on other investment managers or yours. Where other LGPS funds are doing very well, in your words, is where they are using a different model. We use what we call a budgeting model. Others are using a matching model. So in other words, they mark to market something like gilt yields. So they will take a fixed amount of gilt yields, and when gilt yields have risen significantly over the last 18 months, their expectation of future returns has also risen by that same amount. So, for example, where they were assuming their return was 4%, maybe long term, when gilt yields were 2, it's now 6 or 7. We do not believe, and we can look at the state of, you mentioned already, the state of the economy, that just because gilt yields have gone up, equities are suddenly going to start giving you 7% every year in the long term. That's not the model we agree with. So they're having a fixed amount, regardless of what's going on elsewhere. They're having a fixed amount to some market indicator that you don't invest in. So we don't believe that's the way to model the discount rate. So if you do see other LGPS funds who have got fund levels of 120, 130%, whatever it may be, that's because of their model and their discount rate. And guarantee, come the next valuation in 2025, they will not be disclosing those funding levels, and they'll come back down. Back to the point I made, ours are much more stable, because I don't believe anything that's happening in the markets makes me think that we're suddenly going to get much higher returns in the next 10 years than we've had, than we thought we would get 18 months ago.
Okay, Barry, I think that's the last question, mate. Thank you very much for the detail in your presentation and your responses. I think maybe in coming times we might have a training event with you where all members that are interested to come and ask those questions in more detail to give more time. We're obviously in a busy day today. We've got an AGM to get through, so I'll leave it at that. And thank you very much for coming on, and you're quite able to stay and remain. Thank you. Okay, so that's the end of item number 5. Our next item on the agenda is the management and financial performance management presentation, and Keith Polframan, it's our group manager, will do the presentation. Thank you.
Thank you, Chair. So Tamsin is just putting the slides up.
Sorry.
So as Chair said, I'm Keith Polframan. I'm the Group Manager of Financial Services for the Nottinghamshire Pension Fund.
Sorry, it's just not behaving today.
Apologies, some delays. I'll make a start. Hopefully people have got the slides either in front of them or they've had a chance to review them before. So we're going to cover some items in relation to the 2023 accounts, and these will appear in the Nottinghamshire Pension Fund annual report. So we're going to look at some key figures from the accounts. We're going to look at the net additions and withdrawals from members during that year, net returns on investments. We're going to have a slide on the investment management expenses, a quick LGBS central update, and then a summary at the end. Thank you. So key figures are shown on this slide here, which shows the net additions and withdrawals from dealings with members over the last 5 years, some net returns on investment figures, and you can see the significant fluctuations in those, particularly over the last 3-4 years. And the consequential net closing assets, net assets of the fund at the end of each financial year, and the comments already been made by Barry that broadly flat from 21-22 to 22-23. And at the bottom of that obviously shows the actuarial funding level, which is fixed for 3 years following each valuation. And Barry's already covered in detail the movement of that from the time that this was prepared to now. Next slide shows net additions from members, and this is the net position from dealings with members, and increasingly this will be a withdrawal going forwards. This trend can be seen on the graph. The only difference is the year 2021, when a large number of employers made significant contributions to fund deficits, which gave exceptional net additions in that year. They were allowed to make a one-off payment to cover some of their deficit payments for the 3 years at that point. This graph shows the gross movements, so you can see the contributions no longer fully cover benefit payments. Again, 2021 is an exception due to one-off employer contributions, which I've mentioned. The net transfers in and out are marginal, but in future we want to be able to rely on member contributions to cover pensions, but we need to remember that the fund has significant investment income which supports our cash flow. So generally that will be reinvested, but if necessary that can be used to fund contributions to members. Slide 6 shows the investment income that we received, again over the last 5 years, splitting out by the various asset classes. There's currently no requirement for any assets to be sold to fund contributions, so although we're using some of the investment income, we're not using any of the assets themselves. This slide shows the net returns on investments, and the volatility is shown by this chart, and market values are reflected in the changes in values figures that you can see on the chart. And interest rates have impacted valuations during 22-23, causing the modest decrease in the year. Slide 8, this graph shows the overall impact of changes in value in investments, the investment income, net payments to members, and admin costs. For 22-23, this resulted in a small decrease in net assets, as we showed earlier. Slide 9, the stability of the fund's investment arrangements help to keep our investment costs low. So over time we've been able to reduce fee rates as we negotiate lower fees, and we benefit from the negotiating power of LGBS Central Limited, our pool company. However, this benefit has been offset by some moves into more expensive asset classes as we further diversify the fund's investments. And it should be noted that there are some additional fees and charges incurred through pooled investment vehicles. These have the effect of reducing the fair value of the investments rather than showing up as expenses. And the estimated embedded costs within pooled investment vehicles were 16.9 million in 22-23 compared to 15.2 million in 21-22. And the fund continues to work on improving transparency so that fees are more accurately reported. Brief update on asset pooling. So LGPS Central Limited was established on the 1st of April 2018 and is continuing to develop and launch new funds. We currently have investments in corporate bonds, emerging market equities, passive global equities, active global equities, emerging market equities and debt, private equity and infrastructure, and LGPS Central also manages our gilts mandate. And the proportion of our investments managed by LGPS Central will increase over time, and the pension fund, most importantly, retains responsibility for asset allocation, which is the subject of this afternoon's working party. So just in summary, the fund continues to have positive net cash flow due to investment income. Net assets were slightly lower in 22-23. LGPS Central is well established and continues to set up investment funds on our behalf. Thank you.
Thank you very much, Keith. Do any members have any questions to Keith? Okay, I think not. Can I just hand over to Nigel Stevens, who has some important information?
I don't know if colleagues will be aware that this is the last meeting for Keith for the Pensions Committee, because he will become a pensioner himself next week. Towards the end of next week. I'd like to pass on my thanks, Keith, for your support in managing the pension fund for I think about the last 7 or 8 years, which has shown a remarkable increase in value over that period of time of nearly 60%. So that is a rather fantastic achievement in terms of your role. So thank you very much, Keith.
And I'd just similarly like to add my thanks to Keith for the invaluable help, direction and guidance that he's given me whilst I've sat in this chair. So thank you very, very much. Thank you. Okay, after that, so let's move on to item number 7, which is investment performance and the pensions and treasury management presentation. And County Council Senior Accountant for Pensions and Treasury Management, Tamsin Rabbits, will deliver a presentation. Thank you.
Thank you, Chair. I'm Tamsin Rabbits and I'm the Investment Manager from the Nottinghamshire Pension Fund. Today I'm going to talk to you about the returns delivered by the fund's investments over the year to March 23 and how these investments are managed. I'm just going to try again. Thank you. The equities, property and bonds figures indicate the performance against benchmark or market comparator of our main asset classes. Against longer periods, the total fund return remains ahead of the discount rate used in the triennial valuation. At a fund level, the benchmark is partly linked to CPI, so comparative performance will struggle at times of high inflation. Each quarter, the Pension Fund Committee reviewed the performance of the fund and received reports from each of the main portfolio managers. During the year, the fund retained a relatively simple structure of management arrangements with 2 main equity portfolios, Core Index and Schroders, increasing holdings through LGPS Central as part of the LGPS pooling process, and mainly direct property managed by Aberdeen. The specialist portfolio holds a number of pooled funds in a variety of assets. Each fund is externally managed but overseen in-house. Each of the main managers has an individual benchmark against which their performance is measured. The fund's overall performance is then compared to its strategic benchmark and helps to inform decisions around the management arrangements. The strategic benchmark is built up of high-level market indices for different asset classes. The benchmark is based on the agreed asset allocation. The fund's asset allocation is one of the key factors that the committee determines, and this is recognised as the biggest driver of returns. The fund then decides how each asset class should be managed, for example, within a segregated mandate or by external managers, on a passive or an active basis. The performance of the main managers is reported to committee each quarter. A review of asset allocation took place during the year, which proposed some changes which have been approved and implemented during the current financial year. The figures above represent the allocation which applied during most of the last financial year. The current asset allocation is published in our investment strategy statement on the Pension Fund website. This graph of the performance of the passive core index is a good indication of how volatile the stock market can be, indicating that however good one year's results were, they may be significantly different in the future. The Schroders portfolio is similarly volatile. As an actively managed portfolio, performance will vary from the benchmark. This graph shows clearly the impact of lockdown restrictions to combat the spread of the COVID-19 virus in the last quarter of 1920 and ongoing through 2020 and the early part of 2021, impacting portfolio performance, particularly for consumer-related industries. A recovery was experienced during 21-22, but increases in discount rates during 2022 impacted property valuations and significantly affected performance for the year. The LGPS Central portfolio has only been in existence for 3 years. This graph will become more interesting and more indicative of real returns over time, as most holdings, including some private asset investments, have not been held long enough for returns to be meaningful. Where future investments are made through the LGPS Central Asset Pool, decisions over the manager selection will be made by the pool operator. But deciding on an appropriate investment strategy and asset allocation for the fund will still be done by the Nottinghamshire Pension Fund Committee, and this is the most important factor in driving long-term investment returns. So to summarise, the impact of inflation and increased interest rates has impacted both performance and our fund benchmarks in various ways across asset classes. Increased volatility has been experienced. The fund's net assets decreased slightly during 22-23, but total returns over 5 years remain ahead of the actuary's discount rate. Asset allocation is the most important factor in driving long-term investment returns. Thank you, Chair.
Thank you very much, Tamsin. It's very important, some of the last bits you mentioned about our returns being higher than the actuary's returns required in our matching our liabilities. So I think that is really, really important thing you just said. Any questions or comments from any members, please? William.
It's just really common, kind of coming back to address your earlier question, Councillor Camilleri, which is that we make our allocations on the asset side. We may make good decisions, we may make bad ones, but the outcome, as I think you're well aware, is driven by what happens to markets. And you've just seen from Tamsin's presentation that there are certain parts of the market which did had a big negative outturn over the last 12 months. The obvious ones being infrastructure and real estate. And actually both of those were driven at heart by the big rise in bond yields, which was, I think the catalyst for that was actually the mini budget. But in my view, it would have happened anyway, and if that hadn't been the catalyst, something else would have been. But that is what's been driven the big fall in absolute values in infrastructure and real estate. And do remember, the government has actually, I say forced, it's not quite true, but the government has set a target for infrastructure weightings. So we had to have at least 5% in infrastructure. If you look at relative terms, it's not the case that our asset managers have performed particularly badly compared to their peer group or the market. The bottom line is that market outcome has meant that the return of almost all LGPS funds has been somewhere near flat, and we are no exception. But does that help to address kind of the questions you asked earlier?
And I think the other point to raise in terms of investment performance is that we're in this for the long game. This is not a short-term fund, like individuals may want to take high risk and get high returns if they do well, but you've got to remember that actually it doesn't always work out that way. So it's about long-term investment strategy against to match our long-term liabilities. So thank you very much, Tamsin, for your report. Okay, let's move on now. No other questions to item number 8, which is pensions administration. And we had a pensions administration team presentation, and it will be delivered by Sarah Stevenson. Sarah, will you take us through your presentation, please?
Thank you. Good morning. My name is Sarah Stevenson. I'm the Group Manager for the Business Services Centre. Normally, obviously, I'll be doing a double act with my colleague John Clues whilst he is present in the building. He isn't actually here. He's meant to be on holiday. So another busy and challenging year for pensions administration. Obviously this morning we've heard a lot about investments within the fund, but obviously it's crucial that we're able to pay these benefits out to our members as well. So scheme membership continues to grow. We're also working on a number of significant national projects, of which we report regularly into committee. So McLeod, the age discrimination judgment, GMP reconciliation, and the national dashboards is back on the agenda as well. Cost of living, the fund continues to see an increase in members seeking early release of pension benefits. Scheme valuation, obviously we are a contributor to into the scheme valuation, providing data, etc. And obviously you've heard details about the valuation from Barry this morning. Pension regulator itself is increasing its scrutiny across all pension schemes, and obviously we as the officers who are managing the administration side need to ensure that we are complying with those requirements. So one again that we have reported fairly regularly into committee is about the requirement for us to have a data improvement plan, and committee will be well aware that we have been undertaking a significant amount of work over the last few years around data improvement, and you heard at the December committee meeting the details about how we're taking this forward with that transformation change. Regulator is also increasing its scrutiny around cyber security and risk management, and you'll be aware again from previous reports but also a working group meeting that we are reviewing the fund's risk register with a view to presenting the updated register and the new approach to risk management in April. Finally, the General Code of Practice, which will replace the Code of Practice, was laid actually before Parliament yesterday. So that is something that we will need to get to grips with, the detail around that and how that will impact or how we're applying that Code of Practice across the operation that we deliver for members of the Nottinghamshire Fund. Again, you'll have heard previously the challenges that we've had within the administration side around recruitment, but you'll also have heard in Councillor Kerry's opening address this morning that we have sat behind me our first cohort of pension apprentices. I think this is a really exciting opportunity for both Nottinghamshire Fund, but also for the individuals who have taken up those appointments. And again, previously you've heard from John that the LGPS is looking to develop its own pensions apprenticeship, which obviously we will be taking a keen interest in. And also we are making significant progress now on our digital transformation and new ways of working. So this slide here shows scheme membership, how it has increased with some sort of fluctuations across the different categories, but our scheme membership now, as at 31st of March 2023, was in excess of 155 members across those categories of active, deferred and pensioners. Perhaps that should be 703, with Keith shortly to become a pensioner himself. The year ending for 22-23, so this is where we require all employers to submit their data so it can produce annual benefits, albeit that a number of those scheme employers missed the return deadline. We did manage to issue a significant volume of annual benefits statements, and obviously scheme employers continue to be supported by the employer support and compliance team, who are working closely with employers around their year-end submissions and also data quality. So a statutory requirement on the fund is to issue annual benefit statements by the 31st of August each year. On that slide there, you can see the volumes that we are issuing, and clearly this gives members an update on the position of what the current value of their fund is, but also what it is at their state pension age. And also there's some information there on contributions that were handled by the support and compliance team, but also the value of pension payments that we made in the last financial year. Always of interest to the committee is the average cost per member of administering the fund. Previously we haven't been able to report those figures, but this slide here does provide updated information. So the cost per member of administering the Nottinghamshire Fund is £16.65, and that is set against the average cost per member in the SITFA benchmarking club. So that's other LGPS funds, but not all funds. So our cost is £16.65 against the average of £22.55, and clearly there has been commentary around that in previous committee meetings. Again, we report on our annual performance, and this slide here has been presented to committee before on the performance of the administration team, and it shows those key categories such as deaths, both as active pensioners and death in service, retirements being processed, transfers in and out of the fund, and other things such as divorce and refunds. Total number of completed processes in the financial year. This slide here shows that in the last financial year that the team processed in excess of 58,000 processes, which is an increase of 2.95%. So you can see, whilst there was a dip in the early stages of COVID, the team, are processing an increasing number of activities from an administration side. And also, whilst there is a slight dip there against our key performance around activities, clearly there are other activities going on, which I'll talk about shortly, that we'll be looking at how we move our administration service into a digital way of working with new ways of working. So transformation of our pension administration service. Committee approved a transformation programme back in 2019. Progress has been impeded due to a number of key issues over recent times. So the pandemic, the delivery of national projects, which has meant we've had to divert resource into delivering these, increase in requests for deferred benefits and active retirement quotations, and obviously payment ultimately of benefits due to cost of living. We have also experienced turnover of experienced pension officers, and have had, as have other LGPS funds, challenges in recruiting. Since June 2023, we have worked to refresh our transformation programme and are now driving this forward. So I just really wanted to give you a bit of an update on where we are. Again, data is key. There's been a huge amount of activity behind the scenes. We do report our data performance into the regulator whilst that table shows that our common data has remained static and our scheme-specific data has fallen slightly, that has to be set against a backdrop that we have run our data audit against an increase of nearly 15,000 members, but also we have taken an active decision to hold on some of those corrections to data whilst we collect and then load on them a cloud data and complete the GMP exercise. So I think it's fair to say that's remaining static, and that slight fall is due to a proactive decision ahead of loading that other data, which will then see a significant increase in our scores. Compliance with the responsibilities and of the regulations are both for the administering authority and scheme employers. The transformation has seen significant investment in resource and funding to address issues such as data quality, and therefore during 2024 we will be reviewing the pensions administration strategy. And going forward in the annual performance report, we will be reporting on scheme employers' performance against their responsibilities. This will include items such as details of data quality maintenance by scheme employers, adherence to LGPS regulations, and any breaches which we are required to report into the pension regulator. And as I said earlier, the new General Code of Practice has now finally been laid in Parliament, so we will be looking at what that means with regards to both the administration of the fund's responsibilities, but also those that are responsibility of scheme employers. It's a huge amount of activity that has been refreshed since June, but will also carry on over the next year and possibly further. So committee again will be aware that we've had a scheme employer hub running in a number of our scheme employers. This is now a prerequisite to roll that out ahead of a move to monthly returns. So that particular slide there is just detailing that our technical implementation is complete, UAT is underway, and we will be from March onwards working to transition our existing employers to the new hub and then deploying it out to the other scheme employers. On the performance slide, that showed that the area where we need to seek improvement is the percentage of deferred benefits quotations that we're processing within the benchmark. We've been doing a huge amount of work to look at how we automate that process, how we build in the various validations so that we can actually start to move our experienced pensions officers into more complex work. That proof of concept is now in its final stage of testing, and hoping that UAT will commence in early March and deployment into production in early February and deployment into production in March. Then we will look at how we can scope other process to have elements of automation within them. Monthly returns, which will then feed into the annual benefits statements sent out to members. So we're currently in the discovery phase, and we're hoping for initial pilots of that with scheme employers from September onwards. And after a number of issues with the current telephony system, we will be deploying the call centre telephony that's used both in the council's customer service centre but also elsewhere within the business services centre. That will be deployed into the pensions admin team during February. That will also give us the ability to record calls, and there is other functionality that will come eventually around SMS, web chat, those types of activities that we're seeing increase right across the business world these days. The year ahead looks busy. So transformation programme will continue, and clearly items that are delivered through the transformation will then link into our business as usual and how we start to deliver some of our administration service in a different way. We will continue with the delivery of the national projects, the McLeod, the final stages of GMP, and start to ramp up our preparation for national dashboards. We'll be implementing the Pension Regulator's General Code of Practice, reviewing in conjunction with our investment colleagues the Pension Fund Risk Register, and also ensuring that we are in a position to meet the regulator's requirements around cybersecurity and risk management. Thank you.
Thank you very much, Sarah, for that very detailed report. There's a lot of interesting, exciting things going forward. I mean, the Employer Hub, have you a view on the employer's appetite for joining in that project and then getting benefits themselves in terms of not having to keep redoing data or checking it? So improving the whole system of data transfer, etc. And the other one, the call centre. I think a number of members, including myself, have had calls from pensioners that have struggled with their own details, accounts, whatever you want to call it, and we've had to route them to you. So is that going to improve the customer service that we give to our pensioners in the future?
I'll take your second question first then, Councillor Carey. Yes, there have been some challenging times recently with the current telephony solution. There were some configuration changes, but we still received reports of issues in members getting through to the team. I think some of that is actually due to volume of calls coming into the team. The touchpoint call centre telephony will give us much better management information to see the calls that are coming in, how they may be or when they're abandoned within the call processing, but also will give us other functionalities such as being able to enable members to leave a message and then have an automated call back. Obviously that type of functionality will just take some time to bed in within the team. But we do have experience of its use across the rest of the business services centre. With regards to employers' interest, enthusiasm around the employer hub, we have a number of scheme employers where they are already or they take their payroll service through third-party payroll providers, and these providers are already used to submitting data on behalf of scheme employers via a hub through a monthly return. Whilst the responsibility still remains with the scheme employer, I think logistically and logically we will be working with their payroll providers. Again, we have spent time speaking to the LGPS funds. It has been a challenge to get some employers onto the employer hub. And certainly one scheme employer has taken a route of having slightly different and improved SLAs if it's provided through the hub versus if it comes through a different route. I think it's all about the engagement we have with our scheme employers. We've obviously got a number of large scheme employers that would take into account significant membership of our fund, but I think it will be challenging.
Okay. Are there any other questions, comments from members? Councillor Clark.
Yeah, thanks, Chairman. Thanks, Sarah, and thank everyone else for the clear presentations. Because for us who are lay people, it's quite a lot to take in, but I seem to understand most of it. It's just a question on transformation, digitalisation, and AI. That wonderful thing that's now jumped up and down. And to those that are older in years, you think, what the hell's next? But what are the projected savings? Because on AI, but I already just started getting into it over at Gedlin there. And it looks so it's going to be a very, very useful tool, because you've been at some savings there significantly. Have you looked at that at all? Thanks, Chairman.
The system that we currently take from Civica, Universal Pension Manager, there is not a current offering through AI. However, they are developing a model. I think it's fair to say that our human resource within our team is on the lower side, and we have discussed here about the challenges around recruitment. So I think for myself and John, the digital transformation is to take and use the system to automate more standard processes, to release our experienced staff, to give them capacity to deal with more complex issues. And perhaps over time we need to consider how we provide access to those experienced pensions officers to the members themselves, because pensions are it is a complex area, and I think sometimes people want face to face. I think we clearly will be looking at AI as it develops, but it isn't currently. There isn't anything through our system provider, but it's coming. So hopefully in the future we'll be able to give you more detail.
Councillor Tucker, yes.
Hello, good morning everybody. My name is Councillor Kinder Joel Matsiko, but call me AJ, City Council. No, thank you for the presentations. I just want to confirm, because I'm very, as I said, a layperson when it comes to pensions, but I do understand that pensions are mainly paid by the working generation, if put that way. So workers, that's how pensions are run more generally, kind of thinking of basic level. And I've just been hearing consistently that recruitment is a big problem, and I suppose we have a very big problem when we see the Chancellor asking people over 50 to come back into work and so on over the years. So I suppose my question is just really to confirm that understanding. Is it working it up? Obviously, there's real estate and so on, and other investments and other things. But I think primarily is making sure we've got enough workers to pay into the pot for the next generation and so on. And I suppose it's, whilst we had obviously mini budget and other things, what's the consistent impact been of people leaving the UK for political reasons? I mean, I do understand, Chair, you want to be political, but we are politicians, want to really understand the impact of not having enough people in work.
I think you can generally talk about your experience in terms of pensions admin, about the recruitment challenge we face, but how we've solved it or are solving it with the work we've done, for example, with our fantastic new apprentices. The wider thing about the demographic changes in the outside world, I'm not sure whether we have all the answers in this forum. But have you got anything specific you'd like to say?
Yeah, as Councillor Carey said, I can respond to certain aspects of that. So I think two things. I put up a slide about membership of the scheme, so you can see whilst there are three categories there: actives, deferreds and pensioners. Actives are clearly making contributions, financial contributions into the scheme. That has increased slightly. I can't comment about what individual scheme employers may be doing, around their own employments there. Clearly within the fund, there are different types of membership, so you can fully contribute to the scheme, or you can be a 50-50 member. So if people are looking to, from a cost of living perspective, all their sort of like incoming and outgoing, and they consider whether or not to continue to be a member of the fund, then obviously one of the huge benefits is to go to the 50-50 scheme to retain your membership. As a scheme employer, Nottinghamshire County Council have recently launched the ABC Wise scheme, which enables employees of the County Council who are LGPS members to contribute to an additional voluntary contribution pension that runs along the LGPS, alongside the LGPS, and gain both tax relief and national insurance savings. So we have had a significant uptake I believe that's running at the City Council and other funds. So I think there's a way there for scheme employers to promote being members of the scheme. So I can comment on that sort of factor that I would feel comfortable with regards to membership. With regards to recruitment, we have an older aged profile of individuals who are experienced in pension administration. We have challenges around recruitment, hence the route we have adopted to appoint apprentices and in effect grow our own talent. And clearly that does a couple of things. It brings new individuals into the world of pensions. Secondly, what it does is it enables our experienced people who've come at an entry point to also have promotion into their more senior posts as people become pensioners. So we're feeding our structure from the bottom. But I think also the things around digital transformation, etc., open up new opportunities within the structure where it doesn't have to be necessarily around pensions administration. It can be around AI, it can be around digital and how we actually continue to provide an efficient and effective service, but open up different and more challenging opportunities for people.
Do you want to come back on that? Or is that
no, just thank you. I suppose I've got lots of time. This is for the long haul, so I'll be keen to obviously go the course of the day really look into further aspects that weren't able to be covered. But I do thank the officer for the presentation.
Thank you. I think that brings us to the end. There's no further questions. Oh, sorry, Councillor Chapman, didn't see you.
Just picking up Councillor Clark's point, we are always very pleased when we look at how much we spend on admin, because it is low compared to most, and I'm sure it's very efficient. But there's always a danger of concentrating on that, given the marginality of the costs in relation to our turnover, that on occasions it may well be that we actually want to spend a bit more, and a higher percentage might actually give us a better return. And so I just think that we need to look at whether we do need to be putting more up front in this area in order to get better returns further downstream. It's just because I said there is a tendency to sort of keep congratulating them on how little they're spending when sometimes it could be counterproductive.
I'll try to answer that one. We're always looking at the strategy. We're doing a full strategic review about that in the coming months or coming year. Always work with officers to understand what the needs are, and in fact that's how we get into the situation we are now with the apprentices, so to try and find solutions. The key thing is we have key performance indicators which have been presented. There's some strengths and weaknesses, but I think our overall performance is good. All the regulatory stuff that we do is good, so I think I'm confident that we've got positive stuff going forward from that, and the same is for Treasury and other things as well. Are there any more comments or questions? No. Okay, well, thank you very much. That's the end of item number 8. We have an item number 9, which is questions for the members of the public, and we have not received any, so we won't be going through any of those. That really leaves me, unless, Chris, do you have anything to say about anything forthcoming? No? No. Okay. So I'll leave it at that. So thank you very much, everybody, for... Chris?
Yeah, Chair, I'm not sure to address this and what actually to say on this, but it's very likely that, it's going to be happening that I will be basically retiring soon due to ill health. But I would hope with further discussion to see whether I can apply to become a continuing member of the scheme in a different guise, but obviously that's due to committees, whatever, and to see how that progresses. But realistically, because it hasn't happened yet,
Yeah.
I can't actually say to the
Yeah.
point of
Okay.
what, which, and how. But I don't know yet if this is my last meeting or if I've got one more or which. So it's a bit up in the air, but thank you, Chair, for the opportunity anyway.
I just wanted to give the opportunity just in case we don't see you, whatever. But I also like to give publicly my support to encourage you to remain as a pensioner member of the committee, and I hope you'll be able to get through that process. So thank you. Okay, so I think that concludes everything for today. Thank you very much, members. And for those going for the working group straight after this, we're in committee room C, and we'll see you there shortly. Thank you.